Hello, everyone. Thank you for joining us today for our Lunch with Lou webinar. My name is Jimmy Bassett, and I am a senior advisor here at Altfest. Today, Lou will be discussing the results of the 2020 election. After Lou's remarks, I will ask him a few selected questions from our clients that have been submitted. We expect today's call to last about 45 minutes. A recorded video of this webinar will be available should you wish to watch it again at a later time. And now it is my pleasure to present Louis Altfest.
Thanks, Jimmy. Hi, everybody. It just occurred to me that I've finished 2 days of a quarterly investment review. You can't be more up to date than that. And I'll give you a little picture. This is the picture that I have, although my picture should be modified. The picture is of our table, our conference table, with maybe of our 40 people, maybe 20, 25 are sitting around because they have some investment relevance. And then we go around for people who discuss things about their area and bring us up to date in their recommendations. And we have 2 portfolio managers, Mayuk and Sush, who are sort of in charge of things that go on. And that's my vision. Of course, right now, this is being done virtually, just like this conference is being done virtually. All right, so why don't I get started? The country has gone through 2 traumas this year, whatever political side you're on. The pandemic is still a work in progress. For some, the political trauma started on election evening. Do you remember that? And there was a lopsided lead for President Trump that time. And on Tuesday night for Democrats and Friday night for Republicans, the most frequent question that Google had on those 2 nights, frequent requests for each of those people was, tell me where my nearest liquor store is. We'll talk a little bit about Biden's presidential priorities and how the economy will be faring. We'll discuss value investment-wise. We'll discuss value versus growth. We'll discuss domestic versus international. We'll have a partial solution to weak outlook for bonds, which you should pay attention to. We'll discuss your investment results. And we'll end with a 5-point conclusion and action steps, including some financial planning ones, mostly concerning taxation. Let's start with the political outlook. What will Wall Street think of Biden over time? So Wall Street thinks pretty much only of economic growth and profits. They're very dispassionate about things. When I was interviewed by the press the day of the election, I said that the markets would respond positively to Trump's election since he's mostly in favor of less government intrusion and business regulation. On the other hand, I said that a Biden presidency would also be treated favorably because he would spend a lot of money that would speed up economic growth. As it turns out, Wall Street looks like it will get something even better than a win and a win, a combination of the two. The walls through the Republicans and this hold on Senate, they will protect against, as they perceive, and I'm giving you from their perspective. Don't mix that up with my own beliefs or other people's own beliefs, which vary. The Republicans, through its hold on the Senate, are going to protect against a Biden rise in taxation for either affluent individuals or for corporations. The Republicans will also prevent a large-scale spending program that favors larger cities and minorities, which is principally outside their political base. The Democrats still get the presidency, a power base, which will tilt the scale in their favor, including a pared down but still significant spending program. I would say, well, Wall Street will now be concerned about wild spending, or they will be in the sense that there will be less concerned. They'll still be concerned about wild spending, but they'll be less concerned about it, which has already doubled our debt. That's an amazing figure. From 2008 until now, debt as a percentage of GDP has doubled. Imagine that the amount of debt has doubled, and that's at the highest level it's been since World War II. What about President Biden personally, President-elect Biden? Biden reminds me of Lyndon Johnson, President Lyndon Johnson, who knew every senator's weaknesses, and could also squeeze below the belt, if you know what I mean. He wasn't an idea man. He just took Kennedy's program and got it implemented. Super family man. Biden, on the other hand, will use other ways of doing the same thing. He will gently work his way past Republican resistance and compromise. For example, he understands that the infrastructure program, including technology, could be marketed by Democrats as a way to create jobs, and the same item by Republicans as a way to prevent the overtaking of technology by China. In other words, he will have a gentler manner than Lyndon Johnson, but given perhaps greater limitations today, is likely to be affected less by Republicans and intransigence than President Obama's administration was. In sum, do not expect major plays, but do expect some progress over time in such areas as the environment, infrastructure, relationship with other buddy countries and with China, with some wins given to the left and some to the Republicans, while maintaining his own center of the road approach. Call it chipping away. All right, what about the economic outlook? The economic environment is likely to be defined by modest to moderate economic growth. The 33% rebound figure for the third quarter is over. Now it may be close to 3% per quarter going forward. Keep in mind that the timing and amount of government aid will be very important. The Democrats, believing that the blue wave was coming, asked for a larger aid sum and felt they could wait until after the election to get it. Now the package will be reduced and have less impact on the economy. That will put more pressure on the Federal Reserve and their bond purchase program. Once a real COVID aid vaccine comes, it will help psychologically right away. And then when it is distributed to a large part of the population, it can help boost people's consumption. However, it may be a year for that to happen. The new Pfizer vaccine, which I'm sure, thinking about, is promising, but will have to be backed up by hard facts. Corporate profits have been better than expected. That's a good sign. Corporate profits look like they were going to really go down the chute, but the first quarter and the second quarter were soft, but now in the third quarter, they're still soft, but they're much year-to-year comparisons are better. It's probably true that profits won't come back to new highs until 2022 or 2023. The pickup in GDP growth, on the other hand, will accelerate in the second half of 2021 or the first half of 2022. The market at over 20 times earnings, somewhere between 20 and 20.5 or 21.5. To you, that's PE multiples. Just call it, the market is high, but could be helped by an array of favorable developments. Any reversal in business openings will be viewed, of course, negatively. What about our performance? Our performance has been good for the year to date, with more recently developing markets providing strong support for what we've been doing. So, and in general, not only developing markets, international in general lately has been a plus for us. What has not been a plus is value, and we're value oriented, but it's a good thing that we didn't put all our money into value. So you're going to see some figures that are dramatically off. I'm going to see if I can show you on this diagram, looking at year to date, which is the first diagram to the right, correct? And look at what year to date the value is off from the January 1, 2020 till now, off 11.8%, and growth is up 24.3%. That's a 35% difference. That's a difference of 3 years growth in or more in average earnings growth. So what you've seen is that value has really underperformed, and it's underperformed for some time. Anybody in there, logically speaking, would say domestic value is very, very cheap. You notice the two varies? It seems to be completing a trip down, as it did from 1995 to 1999 and got killed. Now it is as cheap now as it was at that time, which led to 3 years of outperformance at that time for value over growth. Domestic growth, on the other hand, normally is at a 20% premium to the market. Now it has a much larger premium. There's a favorable sub-factor. The growth PE is not nearly as high as it was in 1990s. we hold a material but underweighted position in technology. If the economy weakens, technology may well, which when at this point we're not saying that's going to weaken. It holds a uh, it, by virtue of technology giving you earnings, even in a higher earnings in a recession, we could see technology continuing to underperform, technology to outperform for a time. But there's no doubt that value, or there's not no doubt in my mind, that value over time will outperform growth. Stocks versus bonds. The Fed has brought inflation adjusted interest rates down to zero, or even negative or negative rates on an inflation adjusted basis. Stocks, as we said, aren't cheap, but there is potential for further growth taken as a whole over the next 3 years. Bonds, on the other hand, except for certain selected ones, should be used as a portfolio cushion, not as a means of providing return. The only bonds that we could talk about with some enthusiasm are inflation index bonds, because we believe inflation is going to come back. When you spend as much as we've spent, the easiest way to get your balance sheet righted is through inflation, and we may well end up doing that. And it's not as if you even have a choice. If you spend too much, inflation picks up. But we're not looking for that to happen right away. Inflation, that is. But inflation index bonds and non-agency mortgage-backed bonds. These are bonds on homes not by government aided items. And we're invested in both of those categories, which is, as we just witnessed this morning on presentation on how those areas have been strong very recently. Domestic versus international. International bonds are cheaper than domestic ones. Let's look. Now, I'm going to try to explain this as simply as possible. You see those little blue lines on each, a diamond? Those blue lines say, relative to history, where we are right now. Notice that they're above where we are right now, is above what its average has been. Average is in purple, current is in blue. Blue diamonds above average, over higher price. That's why we say that domestic US and the left-hand side is higher priced. Look around, go across, and you will see that emerging markets, you can't even see the blue, it's sort of blurry, but it's right on target. It isn't overpriced, it's fairly priced. So what we're saying is not that we're putting all our money in domestic, but let's go to the next slide that has, yes, look at where emerging markets are over the past. Notice they come to a peak and they're back down to their low. So emerging markets are cheap. Now, also, looking at the chart to the right, we see that developed markets internationally are also cheaper relative to the United States, and perhaps they're not as, we don't see them as cheap as it was at that, as the developing markets are. Because the problem with developed markets are that are mostly located in Europe, and those developed international markets are having the same problems with this. Is it going to, you want me to call it the second leg, or is it the third leg of COVID? And that's going to affect their future. In contrast, we can look at developing markets. There are some countries that have under 1,000 fatalities. These are countries in the far east who have had experience with other disease epidemics, and they were able to use that to put on masks, to keep masks, and keep things going. And China has in a place that we as a country have not created as much restrictions as they have, and now they're benefiting from those restrictions. And as we've seen, they're cheaper in price, and they're actually growing faster. The cheapest, we can conclude by saying the cheapest area of the market is developing markets. What about our plans? Our plans are to be more conservative than average for us. A greater emphasis is being placed on international bonds and emerging market equities. Barring a further sharp deterioration, in our observations are, barring a sharp deterioration in virus figures, we are expecting continued yearly progress tied to aid. Stocks will be strongly influenced by COVID vaccine progress, as you could figure. Our portfolios have been set up to present below average risk. Some other things, one of the things we're going to tell you is we're working to provide an alternative to part of the bond portfolio. If the bond portfolio is a cushion and not providing returns, maybe we could take some of it off the bond area. And we've done it in a few areas, but this is one that's really could be sizable over time. It is our own real estate fund. And some of you have heard about it through our discussions. Most of you who qualify will be able to decide how much to put in if you choose to select it. We are very excited about this investment prospect. And the ones that we've done that I have put my money into, and Andrew, who started this by putting his money into them, have worked out one. Andrew is now smiling over one. I'm not telling you that this is going to be true of all of our investments, or even who the hell knows. But he's more than doubled his money in one investment. And as he told me, he hasn't even seen the property. It's all been built around what was a disaster, and he put it up for sale, and there's a potential bidding war going on for that property now. So that sounds ideal, and I'm not projecting that would continue, but we believe that very sizable returns are possible with this investment. Another item, we believe that inflation is likely to be rekindled and negative, but not at the rate of the 1970s and not right away. Fundamentally, we believe that the new president will provide a favorable long-term impetus to U.S. growth. The spending on infrastructure has the potential to cover any short-term slowdown in the economy and enhance our long-term growth rate. In other words, we believe that infrastructure will happen, and that it will not only happen, but it will help in case we have a point at which the aid given is not by government who's stepping in, which will be lower than the aid that we normally had come to expect in the first 1, 2, or 3 tranches. Was it 2 tranches? The third one isn't going to be as impactful. In infrastructure spending, which is probably not going to happen right away, but will happen, say, a year from now, will be a good boost to our economy. All right, let's go over some of conclusions in a number of areas. One area is income tax planning. Right now, wait to see if taxes will rise. There's a greater chance if 2 Democratic senators in Georgia get elected in January. In my opinion, that's not likely to happen. That means you don't have to do anything unless in timing, or you have to make a decision by the end of December to see if you're going to time this year versus last year in your income. Estate planning, also those considering whether to give away part of their money to their heirs now may best wait. Or on the other hand, doing a Roth IRA makes a lot of sense. And you should speak to your advisor about Roth IRAs. The estate planning going up is more likely in 2022 or 23 for the tax to go up, if it happens at all. Look for inflation, I think I've said this to pick up at the second half of next year. Shift some money from bonds to real estate. It's a good inflation hedge, and prices in many places are still reasonable. Some choices are trade up on your home, buy an investment house, buy a second home, consider our real estate partnership established for your benefit. Now I'm going to give you my grade, G-R-A-D-E, grade for each of the potentials for items to be likelihood and the amount of what needs to be done that will be accomplished. Environment, a B. COVID and other aid for the economy in coming months, B+. Infrastructure. Infrastructure is a real need, and I think we can get both sides to agree to it, so I'm giving it an A-. Diversity initiatives, a B. Immigration, a B. Opening up trade, B to B+. Well, that, I think, winds up my talk.
Sounds good, Lou. Thank you very much. For now, we're going to move into some of the questions that we had set in. So, Lou, I will pose some questions to you, and you can give us the answers here. So, the first question we have, what could we expect to happen to markets if Trump continues to contest the election results or refuses to easily transition power?
Is that what you were all thinking? I know it's a popular question and a legitimate question. The markets currently led by the media are treating Trump's obstinacy as a temporary personality quirk, or others as a schemer and a bluffer. If they begin to believe this is a coup d'etat, the market would begin to weaken. It'll tell you by its weakening if it believes that, and not firm again until the situation is resolved. At this point, the market is thinking that it will not happen, that he'll get off, he'll not interfere at this time. But may go through part of the period, but not the full period. Therefore, folding, although he'll stay on and be a force, but not as president.
Thank you, Lou. For our next question, with the latest news of a vaccine, will we continue to see the market move upward, or were the recent high prices that we saw more of a blip?
It isn't a blip. The market will follow further developments with Pfizer and vaccines that are successful in testing. So I don't think there's a fallback from that unless Pfizer is the only, and then Pfizer finds difficulties. This is a favorable development so far that will have to be, as I mentioned, established by people, by scientific testing.
Thank you. And speaking of favorable environments, the next question, are the higher prices that we're seeing in the stock market a good sign that the economy is getting better?
Maybe a little, given relatively good news in the economy currently, but mostly it represents our favorable beliefs about the future. The market is treating the stimulus plan as being baked in. The stimulus plan should happen, although, as previously discussed, a material lower amount than that could be cut in the deal before the election. Any disappointment in the stimulus plan could lead to doubts about future growth and result in a decline in the stock market, but I don't anticipate that happening.
Great. Thanks, Lou. And our next question, how might U.S.-China relations change under a Biden administration, and how might that impact the strength of the dollar?
Biden will likely try to strengthen trading ties with China, perhaps while talking tough. However, China currently, talking tough just means for public attribution. However, China currently has not called to congratulate Biden, perhaps in response to what they consider our interference with Hong Kong. The only other major country not to congratulate Biden is, take a guess. Yeah, Russia. If China doesn't do so soon, it could hurt the two presidents' relationship. However, Biden is of the type to forgive and negotiate. Look at VP Harris, who attacked him at the domestic presidential debate. I can still picture that when she did so with such passion. But he selected her nonetheless. A deal on trade would lead to a decline in the dollar since international investors would be afraid of economic uncertainty and could pull money out of the U.S. thereby lowering the value of the dollar.
Thanks, Lou. And then for our final question, it looks like there was some upward movement in interest rates with the current news of the vaccine. What effect would this likely have on the bond market and on mortgage rates?
The vacuum could lead to a temporary spending spree. Look at all those people who, when Biden was announced as the winner, almost involuntarily ran out in the street and started to applaud and dance. That same kind of spree could happen for spending, and keeping you in the home, I think, results in a savings that could be employed for a time in that spending spree. And also, that could lead to something of an acceleration in the growth of over the growth rate over the next few years. Normally, that would result in higher interest rates, but the Fed, for another year or two, will attempt to keep rates down to get more momentum. As a matter of fact, the Fed is going to try to put more push into what was going on, learning from what happened after 2008, in which growth was only mild, although it had an advantage. The mild growth led to extended growth for 10 years, but I think that they would like growth to be stronger than it was in 2008. So they will keep rates down. They will accept inflation being higher than normal, but if the growth gets out of hand, and if inflation really gets out of hand, then they will do something that's they'll act to and raise rates to cool the economy down. But let's see if we can get to that first part before we talk about the cooling down. Let's get past the first part.
That sounds good. Well, thank you, Lou, and thanks to everyone for listening and for sending us your questions. If you enjoyed today's call, if you joined today's call late, or you would like to pass Lou's remarks along to a friend, we will be posting a replay of the webinar on our website, and you will see an email once the replay is available. And of course, if you have more personal questions, please contact one of the members of your wealth management team or call our office directly at 212-406-0850. Once again, thank you for joining Lunch with Lou, and have a nice day.